Welcome to our channel, your one-stop source for all things investment. Today, we're diving into the Canadian Pacific Kansas City Limited merger, a significant event that's shaking up the railway industry. This merger, an impressive $27.2 billion deal, brings together two powerhouse railway companies, creating a combined CP-KCS railroad system that's expected to drive improved growth. The merger has already shown considerable influence on the company's revenue, significantly increasing it in recent quarters. However, it's not just about the revenue. The merger is also expected to benefit from market trends, such as recovery in the automotive and potash markets, the resurgence of the housing market, and market share gains. But what's truly exciting about this merger is the potential for synergy gains and the establishment of a competitive cross-border intermodal service. It's not just about two companies coming together. It's about creating a railroad system that's set to redefine industry standards. As the CP and KCS integration continues, we can expect to see ongoing productivity savings and disciplined execution that optimizes service and controls costs, supporting margin expansion in the medium to long run. This merger isn't just about two companies coming together. It's about creating a railroad system that's set to redefine industry standards. Let's delve deeper into the merger's impact on revenue. The amalgamation of Canadian Pacific and Kansas City Limited has certainly made waves, with the company's revenue seeing notable growth in recent quarters compared to the previous year. However, it hasn't all been smooth sailing. In the third quarter, total revenue experienced a year-over-year decrease when compared to the combined pro forma figures from a year ago. This decline was largely due to reduced volume across all three business lines, which outweighed the positive impact of revenue per carload and foreign exchange tailwind. Now let's take a closer look at these business lines. In the bulk segment, there's been a bit of a mixed bag. Revenue from grain increased thanks to improvements in the Canadian grain harvest and increased demand for U.S. grain. But this growth was offset by reduced export potash volumes, a result of a strike at the Port of Vancouver. Coal revenue, on the other hand, remained flat despite volume growth. Moving on to the merchandise business line, the energy, chemical, and plastics segment saw a decline in revenue due to facility maintenance and decreased demand in LPG. However, this decline was partially offset by positive contributions from expanded operations in refined fuels. The automotive sector, though, showed strong growth, fueled by robust demand for finished vehicles. When we turn our attention to the intermodal business line, a notable decline in revenue is evident, stemming from reduced volumes in both the domestic and international intermodal markets. Despite these challenges, it's not all doom and gloom. The company projects an upswing in potash volumes as the strike at the Port of Vancouver gets resolved and the Canpotex facility in Portland comes back online. Plus, they plan to offset Canadian grain headwinds by shipping U.S. grain. The strength in refined fuels and increased plastic exports should continue to bolster revenue in the merchandise business. While the company's intermodal business may face pressures in the near term, the strength in bulk and merchandise segments should offset this weakness. In the grand scheme of things, the integration of Canadian Pacific and Kansas City Limited is expected to bring about synergy gains and establish a competitive cross-border intermodal service. Despite some revenue declines, the company's growth areas tell a promising story for the future. Now, what does the future hold for Canadian Pacific Kansas City Limited? Certainly, the railroad giant is not resting on its laurels. The company's future shines bright with strategic plans that are likely to steer it into a prosperous tomorrow. One of the key aspects of these plans revolves around an expected improvement in potash volumes. The recent strike at the Port of Vancouver has been a hurdle, but as it resolves and the Canpotex facility in Portland comes back online, the company anticipates a sequential rise in potash volumes. But that's not all. The company is also gearing up to offset Canadian grain headwinds. How, you might ask? By shipping U.S. grain. This strategic move is expected to balance out any potential slowdown in the Canadian grain sector, ensuring a steady flow of revenue. Let's not forget the role of the merchandise business. The strength in refined fuels and the boom in plastic exports are set to continue supporting revenue in this segment. These sectors have shown resilience, and the company is keen on capitalizing on their robust performance. However, as in any business venture, challenges are part and parcel of the journey. The company's intermodal business line may face pressure in the near term due to reduced volumes in both the domestic and international intermodal markets. Yet, the strength in the bulk and merchandise segments should offset this weakness, maintaining the company's overall momentum. In the long run, the key factor that's expected to drive the company's growth is the integration of Canadian Pacific and Kansas City Southern. This merger is more than just a union of two companies. It's about synergy. The company anticipates significant gains from this synergy, establishing a competitive cross-border intermodal service that could revolutionize the railroad industry. While there may be challenges ahead, the company's strategic plans and the expected synergy gains from the merger paint an optimistic picture. This is not just about overcoming obstacles, but about harnessing opportunities and steering the company towards a future that's as promising as it is exciting. So, what does all this mean for you as an investor? Let's break it down. Right now, Canadian Pacific Kansas City Limited stock is trading at a discount to historical levels. This makes it a potentially favorable investment opportunity. But why is that? Well, the merger between Canadian Pacific and Kansas City Southern is expected to bring significant cost synergies. These cost synergies, combined with ongoing productivity savings, are set to support margin expansion in the medium to long run. This means the company is not just saving money, but also optimizing their services and controlling costs. In other words, they're operating smarter and more efficiently. And for an investor, that's an appealing prospect. The company's positive margin outlook, coupled with the potential for improved growth from revenue synergies, makes this a compelling consideration for any portfolio. So in the midst of a dynamic market, Canadian Pacific Kansas City Limited stands as a potentially rewarding investment opportunity. That wraps up our deep dive into the Canadian Pacific Kansas City Limited merger. We've explored the impact on revenue, the future prospects, and the unique investment opportunities presented by this merger. The transaction has significantly increased the company's revenue, and the integration of CP and KCS is expected to bring synergy gains. Despite near-term pressures, the long-term outlook is promising, making it a potentially favorable investment. Thank you for tuning in. If you found this video informative and want to stay updated on the latest investment news, don't forget to hit that subscribe button. Until next time, keep your investments on track.